Learning objectives. After completing this digital module, learners will be able to understand the relation between the proper uses of the resources and generation of economic wealth in a country, learn how the goods loses their specific characteristics in the productive process as being transformed into other goods, learn the basic differences between the consumption and capital goods, learn the salient criteria of consumer durables and their contribution in generating the economic wealth, understand the process of measuring the final output by summing total of the monetary values of diverse commodities, learn the contribution of intermediate goods in the economic process, understand the basic concepts of stock and flows in the economic process, understand how the final output is comprised of the capital goods constituting gross investment of an economy, understand the concept of the investment and depreciation in an economy, understand the ways where the consumption becomes feasible through the sustained production processes, learn about two different parts of total output of final goods and services produced in an economy, learn about the basic contributions having made during the production of goods and services, learn the concepts of aggregate spending being equal with aggregate income as earned by the factors of the production, learn about the value added or product method to calculate the national income, learn about the interrelations among production, intermediate goods, and value added in an economy, understand the concepts of the expenditure method to calculate the national income, understand the concepts of the income method to calculate the national income, understand the concepts of gross domestic product, GDP, gross national product, GNP, and net national product, NNP. Learn about the personal income and national disposable income and related with aggregate macroeconomic variables. Learn about the GDP deflator and its related factors. Understand about the consumer and wholesale price indices. Learn about various points where gross domestic product fails to indicate the economic growth of the nation properly. Basic concepts of macroeconomics. What is flow of production? Flow of production involves a continuous movement of items through the production process. It signifies that when one task is finished, the next task must start immediately. Therefore, the time taken on each task must be the same. Flow production involves the use of production lines such as in a car manufacturer where doors, engines, bonnets, and wheels are added to a chassis as it moves along the assembly line. Capital and consumption goods, consumer durables, and final goods. Capital goods and consumer goods are classified based on how they are used. A capital good is any good deployed to help increase future production. The most common capital goods are property, plant, and equipment. Consumer goods are any goods that are not capital goods. They are goods used by consumers and have no future productive use. In economics, a durable good or a hard good is a good that does not quickly wear out, or more specifically, one that yields utility over time rather than being completely consumed in one use. Examples of consumer durable goods include automobiles, books, household goods, home appliances, consumer electronics, furniture, tools, etc., sports equipment, jewelry, medical equipment, firearms, and toys. In economics, any commodity which is produced and subsequently consumed by the consumer to satisfy his current wants or needs, is a consumer good or final good. When used in measures of national income and output, the term final goods only includes new goods. Investment and depreciation. If gross investment is consistently higher than depreciation, net investment will be positive, indicating that productive capacity is increasing. Conversely, if gross investment is consistently lower than depreciation, net investment will be negative, indicating that productive capacity is decreasing, which can be a potential problem down the road. Circular flow of incomes, economic growth and production flow. Real economic growth only comes from increasing quality and quantity of the factors of production, which consist of four broad types: land, labor, capital, and entrepreneurship. Saving and discovery are the two basic ways to improve or increase the factors of production. Saving occurs when present consumption is delayed, and those resources are instead used to enable capital investment. Discovery can include technique or process discovery, technological discovery, or resource discovery. Circular flow of income in a simple economy. The circular flow of income is a model of the economy in which the major exchanges are represented as flows of money, goods and services, etc., between economic agents. The flows of money and goods exchanged in a closed circuit correspond in value, but run in the opposite direction. This is a concept for better understanding of the economy as a whole, and for example, the National Income and Product Accounts, NIPAs. In its most basic form, it considers a simple economy consisting solely of businesses and individuals, and can be represented in a circular flow diagram. Aggregate spending and income. The aggregate expenditure is defined as the current value of all the finished goods and services in the economy. It is thus the sum total of all the expenditures undertaken in the economy by the factors during a given time of period. It refers to the expenditure incurred on consumer goods, planned investment, and the expenditure made by the government in the economy. In an open economy scenario, the aggregate expenditure also includes the difference between the exports and the imports. An economy is said to be in equilibrium when aggregate expenditure is equal to the aggregate supply, production in the economy. According to Keynes, the economy does not stay in a perpetual state of equilibrium, but the aggregate expenditure and aggregate supply adjust each other towards equilibrium. The product or value-added method. Definition of the product method. The product method is used to measure national income in different phases of production in the circular flow. Every individual enterprise adds certain value to the product which it purchases from some other firm as intermediate goods. Secondly, when value added by each and every individual firm is summed up, we get the value of national income. The concept of value added refers to the addition of value to the raw material, intermediate goods, by a firm by virtue of its productive activities. It is the contribution of an enterprise to the current flow of goods and services. It is calculated as the difference between value of output and value of intermediate consumption. That is, value added equals value of output minus intermediate consumption. Method and calculation. Value of output produced by an enterprise is equal to physical output, Q, produced multiplied by the market price, P, that is, P multiplied by Q. From the value added by each enterprise, we subtract consumption of fixed capital, that is, depreciation, to obtain net value added at market prices, NVAMP. Salient steps of value-added method. The main steps for estimating national income by value-added method are: Step 1. Identify and classify the production units. Step 2. Estimate gross domestic product at market price. In the second step, gross value added at market price, GVA-MP, of each sector is calculated, and sum total of GVA-MP of all sectors give GDP-MP, that is, summation GVA-MP equals GDP-MP. Step 3. Calculate domestic income, NDPFC. By subtracting the amount of depreciation and net indirect taxes from GDP-MP, we get domestic income, that is NDPFC, equals GDP-MP minus depreciation minus net indirect taxes. Step 4. Estimate net factor income from abroad, NFIA, to arrive at national income. In the final step, NFIA is added to domestic income to arrive at national income. National income, NNP-FC, equals NDP-FC plus NFIA. Expenditure method on GDP at market price. Definition of expenditure method. The expenditure method is a method for calculating gross domestic product, GDP, which totals consumption, investment, government spending, and net exports. This method produces nominal GDP, which must then be adjusted for inflation to result in the real GDP. Method and salient steps to calculate GDP. Under expenditure method, national income is calculated first by adding up all the items of final consumption expenditure and final investment expenditure within the domestic economy. The resulting total is called GDP at MR. By subtracting depreciation and net indirect taxes from GDP at MP and adding to its net factor income from abroad, we get NNP at FC, or national income. Thus, under expenditure method, national income is measured at the point of actual expenditure. Expenditure method involves the following steps. 1. Identification of economic units incurring final expenditure. 2. Classification of final aggregate expenditure into following components like A. Private final consumption expenditure. B. Government final consumption expenditure. C. Gross fixed capital formation. D. Change in stocks. And E. Net exports. 3. The aggregate of these above items gives us the value of GDP at ME by deducting depreciation and net indirect taxes from GDP at MP. We get NDP at FC. 4. Estimation of net factor income from abroad, which is added to NDP at FC, domestic income, to obtain NNP at FC, national income. Precautions need to be taken while calculating. To avoid double counting, the expenditure on all intermediate goods and services need to be excluded. Secondly, the government expenditure on all transfer payments like scholarships, unemployment allowance, older age pension, etc. is excluded because no productive service is rendered by the recipients in exchange. Income method of calculating GDP. Definition of income method. The income method of calculating national income takes into account the income generated from the basic factors of production. These include the land, labor, capital, and organization. In addition to income accrued from these factors of production, another important component of income is mixed income. Now let's discuss all these components in detail. Method to calculate GDP. In this method, by adding all the sources of income together, a quick estimate can be made of the total productive value of economic activity over a period. The adjustments must then be made for taxes, depreciation, and foreign factor payments. Each of these approaches looks to best approximate the monetary value of all final goods and services produced in an economy over a set period of time, normally 1 year. The major distinction between each approach is its starting point. The expenditure approach begins with the money spent on goods and services. Conversely, the income approach starts with the income earned, wages, rents, interest, profits from the production of goods and services. Formula of income approach. It is possible to express the income approach formula to GDP as follows: total national income plus sales tax plus depreciation plus net foreign factor income. Total national income is equal to the sum of all wages plus rent plus interest and profits. Some economists challenge the notion of including sales taxes in the GDP formula on the basis that taxation is counterproductive. They think it should subtract from total output rather than add to it. However, most people use the income approach that includes sales tax. GDP, GNP, and NNP. The relations between GDP and GNP. The gross domestic product, GDP, and gross national product, GNP, both try to measure the market value of all goods and services produced for final sale in an economy. It represents the monetary value of all goods and services produced within a nation's geographic borders over a specified period of time. Investors use this figure to make decisions about investment in a particular nation, while governments use it for drafting policies. The GNP measures the levels of production of all the citizens or corporations from a particular country working or producing in any country. It includes the compensation and investment income received by nationals working or investing abroad. GNP is less commonly referred to than GDP, but is best described as the measure of national output. Net national product at factor cost. The net national product, NNP, refers to gross national product, GNP, the total market value of all final goods and services produced by the factors of production of a country or other polity during a given time period minus depreciation. The net national product is a key identity in national accounting. Its use in economics research is generally superseded by the use of the gross domestic or national product as a measure of national income, a preference which has been historically a contentious topic. Nonetheless, the net national product has been the subject of research on its role as a dynamic welfare indicator as well as a means of reconciling forward and backward views on capital, wherein NNP T corresponds to the interest on accumulated capital. National disposable income. National disposable income is the sum of the disposable incomes of all resident institutional sectors. It equals gross national income minus current transfers in cash payable to non-resident units plus transfers receivable by resident units from the rest of the world. Goods and prices. Real GDP versus nominal GDP. Real gross domestic product, GDP, is an inflation-adjusted measure that reflects the value of all goods and services produced by an economy in a given year, expressed in base year prices. Unlike nominal GDP, real GDP can account for changes in price level and provide a more accurate figure of economic growth. The nominal GDP is a macroeconomic assessment that includes current prices in its measure. The main differentiating factor between nominal GDP and GDP is nominal GDP includes inflation and is therefore normally higher than GDP. GDP deflator. In economics, the GDP deflator, implicit price deflator, is a measure of the level of prices of all new domestically produced final goods and services in an economy. Like the Consumer Price Index, CPI, the GDP deflator is a measure of price inflation or deflation with respect to a specific base year. The GDP deflator of the base year itself is equal to 100. Unlike the CPI, the GDP deflator is not based on a fixed basket of goods and services. The basket for the GDP deflator is allowed to change from year to year with people's consumption and investment patterns. Consumer Price Index, CPI, and Wholesale Price Index, WPI. The Consumer Price Index, or CPI, is an economic barometer as used to gauge the sum of money which a consumer of a specific region or class has to pay to afford a basket of commodities with a view to consume it at a definite period. On the other side, the Wholesale Price Index, or WPI, can be defined as the commonly used price index which measures the price changes of the goods for voluminous sale, that is, at the initial stage of the transaction when the goods are bought by one corporation from another for reselling it. GDP and its limitations. Distribution of GDP. Concerns of the non-uniformity. If there is a high degree of wealth inequality, the majority of people do not really benefit from an increased economic output because they cannot afford to buy most of the goods and services. Thus, to accurately describe social welfare, it is essential to consider wealth distribution, non-featuring about production and market transactions. Since GDP measures the value of all finished goods and services within an economy, it also includes products that may have negative effects on social welfare. Think of a country with an extremely strong armaments industry that represents most of its GDP. If the arms are sold and used within the country itself, overall welfare will most likely decrease. Of course, this also holds true for other goods and services that may have adverse effects on society. GDP does not account for domestic or voluntary work, even though these activities have a considerable positive impact on social welfare, as they complement the market economy and thus improve the standard of living. On the other hand, GDP does not include black market transactions or other illegal activities that may have a substantial negative impact on overall social well-being. Concerns of externalities. Due to the overuse of various components, more and more negative externalities arise. Example, pollution, overfishing, and social welfare will decrease as a result. This effect is not included in GDP at all. However, at one point, the positive effects resulting from the increase in consumption opportunities may be outweighed by the negative effects associated with the other limitations. Hence, although GDP may on certain occasions be a good proxy for social welfare, it results in a biased description that may lead to unfavorable conclusions. Summary. Let us summarize what we have learnt. The item that is meant for final use and will not pass through any more stages of production or transformations is called a final good. Goods like food and clothing, and services like recreation that are consumed when purchased by their ultimate consumers are called consumption goods or consumer goods. Some goods make production of other commodities feasible, and they themselves don't get transformed in the production process are called capital goods. The goods which are not extinguished by immediate or even short-period consumption and have a relatively long life as compared to articles such as food or even clothing are called consumer durables. The sum total of the monetary value of various diverse commodities gives us a measure of final output. Capital goods or consumer durables, once produced, do not wear out or get consumed in a delineated time period. When it is made from the value of gross investment in order to accommodate regular wear and tear of capital, it is called depreciation. The production of consumption goods would not be feasible without capital goods. Total output of final goods and services produced in an economy in a year has two different parts as the consumer goods and services and the capital goods. The expenditure method measures the aggregate value of spending that the firms receive for the final goods and services which they produce. The product method measures the aggregate value of final goods and services produced by all the firms. The aggregate of incomes received by the households is equal to the expenditure received by the firms because the income method and expenditure method would give us the same figure of GDP. We deduct depreciation from GNP. The measure of aggregate income that we obtain is called Net National Product, NNP. The idea behind national disposable income is that it gives an idea of what is the maximum amount of goods and services the domestic economy has at its disposal. Real GDP is calculated in a way such that the goods and services are evaluated at some constant set of prices or constant prices. Consumer Price Index is generally expressed in percentage terms. We have 2 years under the consideration. One is the base year, the other is the current year. GDP calculated in the standard manner may not give us a clear indication of the productive activity and well-being of a country.